This budget I would like to analyze in three parts. First, the challenges that the government had and how it tried to address with this budget. The second, I'll cover the taxation aspect. And third, we will talk about how it's going to affect the investments and what our market outlook is. So let's start with the first part. The government went into the budget not only with the problem of lower consumption and lower private sector expenditure. They had issues of job creation, they had issues to control inflation, continuing infrastructure spend, yet maintaining fiscal deficit to a lower level, continuing that fiscal consolidation part. So there are a lot of challenges which actually the government was trying to address. There were measures taken which would boost consumption, fuel private sector investments, measures to improve efficiency and modernization of agriculture. Employment and skill development was a big focus. There was a big focus on MSME and become competitive. Urban development, energy security, a big thing out there again. The continue on infrastructure spending, research, development, innovation is taken on, and next generation reform. These are all measures which would take India forward. I think it was fairly well covered and it addressed the issues that was lurking in government's hand. The second aspect I would like to cover is the taxation aspect. So let me first cover the indirect tax. There were a lot of items in which the custom duties was drastically reduced. The direct tax for foreign companies was reduced from 40 to 35%. This will make foreign companies come and set up companies here in India. The angel tax was abolished. This will further fuel or encourage people to start funding startups. Now, from a capital market perspective, there were a lot of changes. The short-term capital gains on listed equity and equity-oriented product was increased from 15% to 20%. The long-term capital gains on financial and non-financial assets is raised from 10% to 12.5%. Now, in the earlier long-term capital gains era, any long-term capital gains over 1 lakh was taxed at 10%. Now that 1 lakh limit has got increased to 1.25 lakh rupees. Further, the period for listed financial assets is 12 months. Non-listed product period has got brought down from 36 months to 24 months. Now this also applies to real estate, REIT, InvITs, all those products. Now one big change which has happened in capital gains is the indexation benefit across all asset class has been taken off. So now the real estate taxation will increase drastically. Now, to curb speculation, the government has increased STT in FNO. In futures, it's gone up by 0.02%, option is 0.1% respectively. In the new era, the buyback of shares will be assumed as deemed dividend income and it will get taxed at your marginal tax rate. So it's again a negative. Now let me come to the income tax slab for individuals. There is no change in the old tax regime. In the new tax regime, there is, however, the slab has undergone a change. The first slab, 0 to 3 lakh rupees, it is zero tax, nil. 3 to 7 lakh rupees, 5%. 7 to 10 is 10%. 10 to 12 will tax at 15%. 12 to 15 will be taxed at 20%. And over 15 lakh will be taxed at 30%. This is the new tax regime, revised tax slab structure. For salaried employees, the standard deduction has gone up from 50,000 to 75,000. So how does it all stack up from investment perspective? So our market outlook in one word would be, we are maintaining a status quo, both from equity and fixed income perspective. We are very positive on the equity market at this point of time. And we feel that India is on a very strong wicket, strong footing to grow from here. Valuation of mid and small cap is relatively higher. Large cap is fairly priced. And we feel that the given liquidity drive, we will see some amount of volatility in times to come. But from a long-term investment perspective, we are at a beautiful position and I would strongly recommend that people try to leverage this volatility by investing via SIP or STP and ride over this volatility to create long-term wealth. From the fixed income perspective, I would like to actually highlight a very important point. The government of India is the biggest borrower in the country. If that goes down, so the interest rate in the economy will tend to go lower. So one important risk from fixed income perspective is the reinvestment risk. What is reinvestment risk? Meaning if you're investing today at 7% interest and few years down the line, if the interest rate is 3%, you'll have to invest at 3%. So what one could do is basically look at investing in long drawn government bonds, which is 20-30 years or 10-20 years, to ensure that you actually overcome the reinvestment risk. The other option is to invest in guaranteed income product of insurance companies, which basically helps you to lock your return for a long period of 20, 25, 30 years, and you could actually get 675 to 7% tax-free return depending upon your age and your time horizon of investments. So this is how I would want you to actually construct your portfolio or reallocate your portfolio based on the new budget. If you still have a question or you would want clarification on few things, please write in the comments below, or if you wish to seek help on your portfolio, you can write or call us on the number below.